Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome back to mini course number 4, and this is part 3 of our 3-part series, and we're calling this Trader's Fear of Missing Out. And just to recap his question, always feel that the market is at the top, so not able to make the decision to get into the market. Keep waiting for the right time and losing so many opportunities just in front of me. I had bad trades in the past, so I feel that if I buy into this market and the market goes down, I'll lose money again. And my assessment was this problem is once again the direct cause of your trading psychology or your trading mindset. If you've been reading any of my blogs, you should have seen my 7-part series on why traders fail. And also we've talked about the same exact thing on our weekly radio shows. What your problem is commonly referred to as is called FOMO, which stands for fear of missing out. Now this is a problem that can be routed into several areas, and I think we've pretty much covered all of those in this 3-part series. But to break it down, you can look in basically 2 areas. The first being your mindset, where your fear is controlling your decision making. And the second being technical, where you're not experienced enough in reading the markets via the use of technical analysis and therefore don't feel confident enough to actually pull the trigger and enter the market. Okay, in this final part of our 3-part series, I will actually open up our trading platform Thinkorswim and show you how to set up your charts and then how to use that information to determine how and when to enter the trade and then of course when to close that trade. Where we use the current market data, since part of your question dealt with a market that was in a prolonged uptrend, and for sure this market currently is in exactly that. So we'll be using the SPX chart for this lesson, but what I'll show you will work exactly the same for any kind of stock chart, future chart, currency chart, anything you can come up with. So get ready to take some notes. Okay, so here we are inside the Thinkorswim trading platform, and we have here a section of the SPX chart. We're looking at daily candles, and what I want to do is kind of just work our way through here and try and show you how to gauge when to get in, when to get out, etc. So there are basically, I said it in the text earlier on, that if I was limited to only having 2 indicators that I could use to predict entries and exits, the 2 that I would use is what I want to show you here. The first being, and actually it's the most important one that I can think of out of any of them, is called swing points. So what we're going to do first is turn on auto-generated swing points here. Okay, so now you can see the little dots that we have. The ones on the top of the candles will be swing highs. The ones on the bottom of the candles will be swing lows. So with this now in place, forget this blue line. It just came in with the indicator, but we don't need it for anything. It means nothing. Let's assume that you were short the market, let's just say, and you're wondering, first off, since you're short, your next decision you would have to make would be when to exit. So a definition of a downtrending market is you're constantly making lower swing highs and lower swing lows. And what you're looking for is for that pattern to change. That's your clue to get out. So let's assume that you have been short all the way down here. We're making swing low, lower swing low, lower swing low, and swing highs, a lower swing high, a lower swing high, and so on. So you've been short the market all the way down, and you're thinking, okay, this market may have played out at this point. We've gone a little too far probably. When should I get out? The first thing you're going to look for is for the pattern to shift. So if I said that a definition of lower swing highs and lower swing lows is a definition of a downtrending market, then the opposite has to be true for an uptrending market. that would be higher swing highs and higher swing lows. So then, the first thing you're going to want to look for is for the swing low pattern to change. So coming all the way down here, we kept making lower highs and lower lows, right down to the bottom here. Now, the next swing point that we had was a swing high, which was still lower than the prior one. So everything there was okay. So we could have had this correction here and then continued on down, but we didn't. Instead, we made another swing high, which was technically a wee bit lower than that one. So our downtrend still intact at that point. But then we make this swing low here, which is now higher than the prior swing low. So this swing low here, being higher than the last one, now breaks the pattern of a downtrend. So now the next thing you want to look for in confirmation that the uptrend is actually beginning is for either a higher high and higher low, or at least for the candle to exceed where your last swing high was. So in that case, it could be either of these because they're so close together. So what I would look for is once we made this swing low, which was higher than the prior, and we had our swing highs behind that, I would look for price to exceed either or both of these. So in the next candle, it did. It went up and we closed right there, which was higher than those two. So now we have confirmed, just because of the fact that the price action reached this level, even though it was not a swing high, we know that when it does make the next swing high, it has to be higher than these two because we're already playing above that. So in other words, this candle here would have been your clue to exit the market. So you would have made whatever profits you made on the way down until about somewhere in here, and that's where you were to close the trade. So you would have missed some of this, and remember, there's nothing out there that will guarantee that you can pick bottoms and tops, so you don't even try for that. But this candle here, because it exceeded the prior swing high and our swing low was higher than the prior, that was a signal to get out, or get out and or reverse. So if you want to be in a trade that is continuous, in other words, you're short when you should be short and long when you should be long, this candle here would either have been A, your signal to close your short position, or B, close the short position and open a long position. So let's assume we did B, we opened a long position. So now in this candle, we are long. So now we want to start watching out for, remember, definition of an uptrend is higher swing lows and higher swing highs. So here is our last swing low. The next swing low we had was right here, which was higher than that. We're good. Next swing point we made was actually the same candle, was a swing high, which was higher than this. Still good. Next swing point, swing low right here, higher than the prior. Next one right here, higher than the prior. This swing high, higher than the prior. This swing low, higher than the prior. This one here, lower than the prior. So this, at this point, if we didn't have any evidence of candles from there on, if we were only at this point looking back, we would say, okay, pay attention. Now you want to look to see if the next swing low was lower than this one. In other words, somewhere down here, then that would be an indication that an uptrend had at least temporarily stopped. But what happened was, next swing low is higher than that, so the uptrend is still intact. So now, our next candles or so, we look for the next swing high here, which is higher than the prior. Next swing low, lower than the prior. Higher than the prior low, sorry. Next swing high is higher. Next swing low is higher. Swing high is higher. Swing low is higher. Swing high, higher than the prior swing high. Swing low, higher than the prior swing low. Swing high, higher than the prior. Swing low is lower than the prior. So this is our first, again, indication that maybe the trend is shifting. So at this point, we have to watch out for what the next swing point comes along is, and that is right here, which is lower than the prior high, or low, I'm sorry. Too many lows and highs in this explanation. This low is higher than the prior low. So this is a confirmation that possibly it has flopped and changed, and now we might be going into a downtrend. So we'd want to pay attention. So if you were long all of this direction up here, I would say this would be a good spot to close it and take your profits, and at least just watch. Doesn't mean you can't get right back in, but at least just watch. And as it turns out, we turned around and went the other way. Now that the next swing high is higher than the prior one. So we were good. We were good there. And we could keep following along. Next swing high is higher than the prior, so uptrend is still intact. Swing low, lower than the prior. Swing high right here is higher than the prior. Now we have a swing low here that is lower than the prior swing low, so again, you'd want to pay attention and see what follows. If you had reversed and gone long again here, this might be a good place to close the trade. Now this swing low is lower than the prior swing high, so this high is higher than this swing high is lower than the prior swing high. So now we have a lower low and a lower high. So this is looking pretty solidly now into bear territory. Candles are heading down. That swing high technically was higher. The swing low was technically higher than the prior swing low, but now we have to still pay attention to the swing high and see if we can exceed that prior one. We know we are now because price action has exceeded that. And up we go. Now we're hitting a new high from here. On up, new higher high. Higher high again, higher low. So in other words, the uptrend is still intact. Another higher high. Higher low. Uptrend still intact. Higher high. Lower low. So pay attention now. That's a wake-up call. But forget it, because we exceeded prior swing high with price action. So we know the next swing high has got to be higher, which it was. Lower swing low was higher than the prior swing low. Higher high than the prior. Another higher high. Now once again we have a lower swing low than the prior. In other words, you want to pay attention again. If you were in this run up, this might be a good spot to close and or reverse. Swing high is lower, so we're still in a downtrend. Okay, confirmation. Now this swing low is lower than that one, which is lower than that one. Two swing highs, this one lower than that one. So now technically we are definitely in a downtrend. So if you were in this uptrend, now is when you'd want to get out and or go short. Low, lower than that one. This high is lower than the prior. This low, much lower than the low. So I think you can see, I don't need to go, we can go on like this for days. But if you just follow swing points will tell you when to get out of a trade if you're in a long run. And I think that was your problem. The market had been running up and running up and running up, and you were afraid to jump in because if it did reverse and go the other way, then you might incur a loss. Whereas it's my what I'm trying to convince you of here is that watch the charts, watch the swing points, and anytime you get a little correction where the swing points reverse the pattern, like if you're in an uptrend and it's higher highs, higher lows, all of a sudden you start making lower highs or lower lows, watch that move. That might be a good spot to get in. And then once it turns around, once the correction has been made, get in and see how far it can go. Worst case that could happen is you might get in and get whipsawed, faked out in other words, and then get into a trade that might result in a small loss. But then that will sync you up with the market, and then just go with the market. So that's exactly what I would do. There's nothing that you can wait for that's going to happen that this will not tell you if you just follow swing highs and swing low patterns. So that's the first indicator, and if I only had one that I could use, this would be it. Now, since I said I had two, this is the second one that I would add and show you about. So let's see if we can find it in here. And let's see if we can edit that too. Nope, not on this one. Okay, we'll just go with it the way it shows. Now this is called a parabolic SAR. And SAR stands for stop and reverse. So, let's say, we'll go back to the beginning like we were. Let's say you were short the market for this move down. What you're looking for is, as long as the dots are above the candles, you want to be short. When the dots are below the candles, you want to be long. And another good filter to add into this is that when you can see the market is trending up, you might want to ignore the times like right here to where the candles, when the dots move above the candles and it says go short. That would be a signal to close and wait until the candles flipped again. So if you incorporate this in with the swing points, remember I showed you through here how we might have got a indication that the market might be shifting, like we did from this swing point to that one, but then we'd want to look for the next one, which this one canceled that out and this candle here exceeded, so we knew it was a fake out. And at that point the dot switched, you could have gone back in long again. So if you were using these swing points as fine-tuning, but use the parabolic SAR dots as overall guidance, you would have been short all the way through here. Remember I said before that once it turned around that this would have been the candle here that I would have gotten back in on. Whereas with the parabolic, it was a little sooner. It would have gotten back in long right here. So you could, once it flips, then depend on the candles to confirm your entry point, which would have happened here. You would have missed a little bit. Probably wouldn't have missed hardly anything at all because we sold off a bit. So I would have waited till here to get in. But now you have confirmation with the SARs. And you could have rode this up, maybe closed out and been in cash right in this area. As soon as it flipped again, go back long again, and you would have been able to ride this all the way up until we got up to the top of this movement. And this is one caveat that you have to be aware of. SARs do not work well in sideways markets. So when we get up to this point here, if the market appears to be going sideways, that might be a time where you would just want to not be in the market at all because you're going to get whipsawed around. But as we move forward, you'll see that we flip back to the buy side right here because the dots were below the candles, and then keep following that. That would have kept you in the trade all the way up. You would have had this whole move in the bag. A fake out here, you would have gone long again. Now we flipped. And now you'd want to start watching dots to see if the pattern actually flipped to a downtrend pattern, which it did by this SAR. So now you know that the dots here are actually viable, and you do want to be short. So then you could have followed that trend all the way down until we didn't go that far before, until it flipped again, and so on. So if I was going to use only two indicators, I would first follow, study, and learn how to use swing highs and swing lows and the patterns that they show. And then I would add in as a second confirming indicator parabolic SAR. And with those two, I think you could be in whatever you want to be in safely. And the parabolic SAR, if nothing else, will keep you safe. It will not let your losses get too big. And actually, another thing to do, if you're using parabolic SARs and you say you're dealing with a stock and you want to use stop loss orders, use the parabolic SAR as the stop loss. In other words, as this trend was moving up, you would want to keep adjusting. In other words, do a trailing stop order and adjust your stop loss orders every day as a new dot appears. So in other words, you'd be moving your stop loss orders up. So even if you did get taken out, you're going to get taken out at a very tight stop. And sometimes the market will take off and your stops won't be so tight. But if you always place your stop loss orders at the most recent parabolic SAR dot, whatever number that is, and you can just put your cursor over that dot and see over here to the right what number that is. That's an excellent way to trade, and that will keep you safe. And you will be in for the long runs, and anytime you get stopped out, they will be very small. So again, if I only had two indicators, swing points and parabolic SAR. And hopefully this helps you, but I promise you, if you use these two and you follow them, use the dots to place your stops, you will be safe in getting into a market no matter where it's at. And it will tell you when to get in, when to get out, and when to be in cash. So hopefully this helps. Thanks and good luck. Now I hope you enjoyed this live charting tutorial, and I hope to help you see just exactly how easy it is to predict entry and exit points just by using two basic charting indicators. So just in case you were not taking notes, let's review the charting setup you just watched. The chart was SPX, and the time frame was 1 year's worth of daily candles. And the indicators I used were swing points and parabolic SARs. Now, as I said, I limited this example to just two indicators just to show you that you could easily predict entry and exit without a ton of indicators on your charts. But in our actual charts that we use on a daily basis, we use a combination of 12 indicators. But that would have been too much for this little mini course. So if you want to learn more, we offer several classes that cover all 12 indicators and how to use them together. But I think you should now be able to see that you should not let a market that happens to be overextended stop you from getting in. In fact, I would suggest that you watch this entire three-part mini course several times, and then back away from live trading for a period and just paper trade until you get a feel for what I've showed you here. Then, once you feel confident, then switch over to live trading, but keep your position size to the minimum. That way you can build up your self-confidence and trust in the process. Then slowly start to increase your position size over a several-month period until you're back to where you were and to a level that your trading account can support. So to wrap this all up, I just want to state once again that I feel your problem is a two-part problem. First part being your mindset or your psychology, and you're allowing your fear to control your confidence and your trading decisions. The second part being that you needed a predictable system that would guide you for when to enter and when to exit. And because without that, your lack of insight would just allow your emotions to remain in control and you'd remain frozen, unable to pull the trigger. So I might also suggest that you take some time to view some of our other mini courses, because the information contained in those will also help you build on everything we've covered in this three-part series. Otherwise, I hope this helped, and I want to see you get back into the markets because, as you said yourself, you're missing too many opportunities. But to recap, as I always do, just in case all of this seems too large of a task for you to take on, I'd like to suggest another option, and that is to consider coaching. Coaching is something that's used by every successful professional, at the same time something that's almost never thought about for the average person. But if you think about it, golfers, boxers, sports teams, skiers, actors, even rock bands, they all have coaches, and this list could go on and on. And for one thing you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders out there have coaches. All brokerage firms employ in-house coaches to support their in-house traders. Even when I worked on Wall Street, I used their in-house coach all the time. So whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There's not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's all about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book, and we'll give you access to a free 1/2 hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.